Imagine, for just a moment, that you are the architect of an absolute e-commerce juggernaut.
Right.
You are achieving the kind of hypergrowth that just leaves Wall Street analysts, practically speechless.
Oh, yeah.
You're expanding into entirely new countries, you're laying down massive physical infrastructure, your warehouses are humming, and your delivery trucks are just everywhere.
Firing on all cylinders.
Exactly.
Yep.
Firing on all cylinders. And then, out of nowhere, you get the call.
The worst call you can get.
Yeah. You discover that an insider, a former employee, someone who actually knew the architecture of your system, has just walked away with the data of over 33 million of your customers.
I mean, it is the ultimate nightmare scenario for any executive team.
Total nightmare.
You go from playing offense to playing defense in the blink of an eye.
So how on earth does a multi-billion-dollar company navigate a crisis of that magnitude? How do you regain the trust of millions of people while simultaneously keeping your foot firmly pressed on the gas pedal of global expansion?
It's a massive balancing act.
It really is.
Yeah.
Welcome to today's deep dive. We are looking at a truly fascinating stack of sources for you today. We're going through Coupang's Q4 2025 earnings report, the accompanying conference call transcript from February 26, 2026, and we're balancing that with some very sharp, critical financial analysis from MarketBeat.
It really is a remarkable scenario to pull apart because what we are looking at in these sources isn't just a standard dry quarterly financial update.
No, not at all.
It is a real-time, high-stakes case study in crisis management. Our mission today is to distill exactly how a massive logistics and technology platform balances a sudden, severe shock to its system with long-term, aggressive strategic goals.
Right.
The story hidden beneath all these earnings numbers isn't just about a data breach. It is about the fundamental clash between physical supply chains and digital security.
And just how resilient a modern business actually has to be to survive.
Precisely.
Okay, let's unpack this because we really need to dive straight into the massive Q4 data incident.
We do.
When I was reading through the forensic investigation detailed in the call by their general counsel, H.L. Rogers, the sheer scale of the number is jarring.
33 million accounts.
33 million. But the specifics are where it gets really uncomfortable. Out of those 33 million, the former employee actually retained data for a much smaller subset.
Right. It was about 3,000 Korean accounts and exactly 1 Taiwan account.
Exactly 1. And the data they captured included names, emails, phone numbers, delivery addresses, and this is the detail that actually made me stop reading.
The lobby codes.
Yes, building lobby codes for over 2,000 of those Korean accounts.
Yeah,
2,609 to be exact.
That specific detail changes the entire complexion of the breach, doesn't it?
Totally. I mean, think about that from the perspective of the consumer. It's one thing if a hacker gets your email address, you get some extra spam, maybe a phishing attempt.
Right.
But knowing the physical entry code to your front door.
Yeah, that completely crosses the line from a digital annoyance to a physical safety hazard.
Even though the forensics confirm that no financial data, no passwords, and no government-issued IDs were compromised.
Which is a relief, but
Still, if I'm one of those customers, I'd be changing my locks, let alone deleting my app.
what's fascinating here is the finding from the cybersecurity firm Palo Alto Networks. Coupang brought them in to conduct a comprehensive, independent investigation.
Yeah, the third-party audit.
Exactly. And Palo Alto concluded that this wasn't a systemic failure of Coupang's external security measures. It wasn't some shadowy international hacker group breaking down the external firewalls with a brute force attack.
Right, it wasn't the typical movie hacker scenario.
Not at all. It was a targeted attack executed by a malicious insider.
Wow.
This former employee leveraged inside knowledge of the systems and exploited a completely valid software development process.
Which is a terrifying reality for any tech company.
Because the call is coming from inside the house. You can build the thickest vault door in the world, but if the bank teller decides to walk out with the cash...
The vault doesn't matter.
Exactly. Coupang managed to identify, close, and fully remediate that vulnerability back in November 2025, but the psychological damage to the consumer base...
Already done.
That was already done.
And you can clearly see in the transcripts that the business fallout was immediate. People freaked out.
Naturally.
They started removing their saved payment methods, frantically changing their passwords, and in thousands of cases, just outright deleting their accounts.
It's walking away entirely.
So Coupang decides they have to make this right, and they launch this massive remediation effort. They issue approximately $1.2 billion with a B in customer vouchers.
That is a staggering amount of capital.
$1 But I have a question about that because handing out $1 billion in vouchers sounds easy on paper, but logistically, how does a company actually execute $1 billion apology? Is that just fake spreadsheet money, or does that actually hurt the
Well,
business?
it absolutely hurts. It's not fake money at all.
Well,
When you issue a voucher, you are essentially giving away your profit margin on future sales.
oh, I see.
Or, in many cases, taking a direct loss on the cost of the goods sold just to keep the customer in your ecosystem. It's a massive hit to your liabilities. It represents real inventory leaving the warehouse that you are no longer getting paid cash for.
I want you, the listener, to really consider that for a second. Consider the absolute fragility of consumer trust.
It's so delicate.
You can spend a decade and billions of dollars building intense customer loyalty, perfecting your delivery routes, optimizing your app,
And then,
and a single bad actor exploiting a routine development protocol can force you to instantly vaporize $1 billion just to say, we're sorry.
and that fragility immediately translated into massive financial shockwaves. When you look at the market beat analysis alongside the Q4 performance numbers, the sheer cost of that broken trust becomes quantifiable.
Right.
Coupang is a company that is historically accustomed to beating Wall Street's expectations, but here they clearly missed them.
Let's look at those hard numbers, but let's translate them so we can actually understand the damage. I don't want to just read a spreadsheet here. How bad was the actual financial crater left by this incident in Q4?
It was significant. To give you the rounded picture, their revenue for the quarter came in at around $8.84 billion.
Okay.
Now, on the surface, that's still up 11% compared to the previous year, but it missed analyst expectations by nearly $285 million.
That's a big miss.
And their earnings per share actually went negative. They posted a loss of 1 cent when the market was expecting a consensus profit of 2 cents.
Ouch. -1 cent.
It gets heavier. Let's look at a metric called adjusted EBITDA.
Explain that one quickly.
Think of adjusted EBITDA as the actual cash profit generated by the core day-to-day operations of the business before you worry about taxes or accounting depreciation.
Got it.
That core operational profitability fell by 37% year over year to $267 million. And their free cash flow, the actual cash they have left over after paying all their bills to maintain the business, dropped by nearly half for the year, down to $527 million.
Wait, hold on. Their free cash flow dropped by 50%.
Yeah, nearly 50%.
Getting your cash flow cut in half sounds like a total disaster. How do you run a business when half your spare cash just vanishes?
That's the critical nuance here. The timing of this breach in late 2025 is the context for those scary numbers. During the earnings call, the CFO, Gaurav Anand, explained that the cash flow hit was predominantly due to the data incident's impact on working capital.
Working capital.
Right. Working capital is essentially the money tied up in the short-term day-to-day operations, paying suppliers, managing inventory, and dealing with those massive voucher redemptions we just talked about.
So the $1.2 billion apology.
Exactly. So it's an immediate, massive drain on liquidity, but it's not necessarily a permanent destruction of the underlying business model.
Okay, that makes sense. It's like having a massive, unexpected medical bill. It wipes out your savings account for the year, but it doesn't mean you've lost your job or your earning potential.
Precisely. It's a shock to the system, not a fatal blow. But the deceleration of their momentum was still severe. Gaurav Anand laid out a timeline that really illustrates the panic.
Let's hear it.
Before December, their product commerce segment was growing at a very healthy 16% in what they call constant currency.
Quick pause for the listener. When companies say constant currency, they just mean they are stripping out the messy, unpredictable fluctuations in foreign exchange rates so you can see how the actual business is performing.
Yeah.
It's like measuring your running speed on a flat track instead of constantly adjusting for running up and down hills.
Great analogy. So they were running at a 16% growth pace on that flat track.
Which is fast.
Very fast. But then the breach is disclosed, the customer panic sets in, and people stop buying. Management estimates that the panic dragged their growth down so sharply that it hit a low of just 4% growth in January.
Going from 16% growth to 4% growth in a matter of weeks.
Yeah.
That is staggering for a company of this size. You are essentially watching the brakes being slammed at a speeding freight train.
You are. But the sources also note some very clear signs of stabilization, which is why the train didn't completely derail.
Right.
The executive team pointed out that as the actual facts of the breach became clearer to the public, specifically the hard confirmation that no financial data or passwords were taken, the panic naturally began to subside.
Right. Once people realized their credit cards were safe, they slowly started coming back. I saw in the transcript that WOW membership churn, which is their premium, Amazon Prime-style subscription service, spiked dramatically in December, but has since stabilized and returned to normal historical levels.
Exactly.
And despite all of that chaos and the deleted accounts, they still reported 24.6 million active customers for the quarter.
That stabilization is the key takeaway for their core business. It shows that their underlying value proposition, the incredibly fast delivery, the vast selection of goods, was strong enough to weather the storm once the immediate fear was addressed.
The strong foundation.
It is, but it remains a stark reminder that in modern e-commerce, a security issue isn't just an IT department problem. It is an immediate existential threat to your liquidity and your operational momentum.
Here's where it gets really interesting.
Oh, definitely.
Because if you only looked at that core product commerce wobble in Korea, if you only focused on the data breach, you would miss the other half of the story entirely.
You would miss the growth engine entirely.
Right. While the core business was putting out this massive fire, Coupang's other segment, what they classify as developing offerings, was absolutely exploding. Developing offerings hit record revenues of $1.4 billion for the quarter.
Up 32% year over year.
Exactly. Up 32%. And the undisputed crown jewel of that segment right now is Taiwan. The earnings report shows Taiwan is experiencing triple-digit revenue growth.
The Taiwan expansion is honestly a masterclass in aggressive physical scaling.
It's wild.
They aren't just launching a localized version of their app over there and hoping for the best. They are actively, aggressively building out their own proprietary logistics network from the ground up.
And the logistical flex that Bom Kim, the CEO, casually dropped on this call is just unbelievable. He stated that 75% of their volume in Taiwan in December was delivered next day.
Which is incredible for a new market.
And critically, that wasn't outsourced to third-party couriers or local postal services. That was handled via Coupang's own last-mile network, which they've rapidly built out to cover nearly 70% of the country's geography.
Just phenomenal execution speed.
Oh, and as a quick aside on that developing offering segment, the Farfetch acquisition, which is their big play into luxury fashion, finally hit a major milestone.
Right, the first positive quarter.
Yeah, it generated its first quarter of positive year-over-year revenue growth and positive overall economics since Coupang bought them out. So their alternative growth engines are absolutely firing.
If we connect this to the bigger picture, the logistical achievement in Taiwan is arguably the most critical strategic takeaway from this entire earnings report.
Tell me more about that.
Bom Kim emphasized something very specific. They are achieving this massive 75% next-day delivery volume in Taiwan without meaningful increases in variable unit cost.
Okay, let's break that down for everyone. Variable unit costs. Why is that the magic phrase?
Think of it like a pizza shop. Building the physical shop, buying the industrial ovens, and hiring the delivery drivers, those are your massive fixed costs.
Got it.
The variable unit cost is the cost of the dough, the cheese, and the gas to deliver one single additional pizza.
Right.
Bom Kim is saying that as they deliver millions more packages in Taiwan, the cost to deliver each individual extra package isn't going up.
That is the holy grail of logistics.
It truly is. It means they are gaining massive operational leverage. They are putting the heavy, expensive fixed cost infrastructure in place up front, and now, as the consumer volume scales up, the whole system is becoming highly efficient and profitable on a per-unit basis.
They are essentially copy-pasting the dense, high-speed fulfillment model that made them dominant in Korea.
Yes, and they are executing it at warp speed in a brand new country.
Okay, I hear that, but I have to play devil's advocate here because that perfectly transitions us to their 2026 financial strategy, and the numbers are wild. In the call, management calmly projected that this developing offering segment will incur adjusted EBITDA losses of around $950 million to $1 billion for the full year of 2026.
$1 billion loss projection.
Wait, $1 billion in projected losses after they just lost half their free cash flow to a data breach. How are investors not hitting the panic button and running for the hills on that kind of cash burn?
It's a completely fair question, and it's exactly what analysts zeroed in on. But listening to the executives explain it, this isn't a desperate company burning cash blindly on marketing just to acquire eyeballs.
Okay, what is it then?
This is an incredibly deliberate, disciplined capital allocation strategy. They're choosing to take those massive financial losses now specifically to build physical moats.
Physical moats. Explain how losing $1 billion builds a moat.
building state-of-the-art fulfillment centers, purchasing delivery fleets, securing local inventory, and hiring thousands of warehouse workers. These require staggering upfront capital.
Right, concrete and trucks aren't cheap.
Exactly. You have to spend the money before you make a dime. But Coupang views this as building foundational infrastructure. Once that physical network is poured in concrete and running efficiently, and it provides an unmatched customer experience like guaranteeing next-day delivery on millions of items, it becomes incredibly difficult, almost impossible, for any competitor to come in and replicate it.
Because they'd have to spend their own billions to catch up.
Yes, you can't just write a line of code to beat a warehouse full of delivery trucks.
That is such a crucial point, and it perfectly sets up a broader theme that came up during the Q&A portion of the earnings call. Xiang Xiao, an analyst from Barclays, brought up a very topical concern sweeping through the markets right now.
The AI scare.
The AI scare. There is this pervasive fear in the capital markets that AI agents and hypersmart chatbots are going to disintermediate traditional e-commerce platforms.
Right.
The idea is that soon you won't go to an app to shop. An AI will just scour the entire internet, find the cheapest possible product from any random supplier, and buy it for you, bypassing the traditional platform storefront entirely.
It's a very common anxiety in the tech sector right now. It's the fear of the invisible middleman. But Baumkim's response to that analyst was incredibly revealing about Coupang's core operating philosophy.
How so?
He firmly pushed back against the idea that Coupang is vulnerable to that kind of purely digital disintermediation.
Yeah, his quote was great. He specifically pointed out that Coupang is not just a marketplace made of, quote, electron.
Just electrons, right?
They are not just a lightweight piece of software matching buyers and sellers in the cloud. They are building real retail, real fulfillment, and real logistics operations. They have physical inventory sitting on physical shelves and human beings moving it in real trucks.
Exactly. He framed artificial intelligence not as an existential threat, but as a powerful amplifier for their existing physical network.
An amplifier.
Yes. He argued that AI will amplify their ability to deliver on their three core pillars: selection, service, and savings. AI will help them optimize warehouse routing, predict consumer demand with frightening accuracy, and lower supply chain costs.
Makes total sense.
But, and this is the critical distinction, an AI chatbot cannot manifest a physical box and put it on a customer's doorstep the next day.
It can't teleport goods.
Exactly. The physical movement of atoms in the real world is a barrier that software code alone simply cannot cross.
But building that physical barrier, maintaining those trucks, and building those warehouses requires a massive amount of capital. You can't build a physical moat if you're broke, which is why the financial fortitude aspect of this report is so important.
Right. To round out the picture on their stability, the sources highlight that despite the billion-dollar voucher payout and the massive investments in Taiwan, Coupang ended the year with over $6 billion in cash.
$6 billion in the war chest.
Over $6 billion, yeah.
And on top of that, they are so confident that they are actively returning capital to their shareholders. They've been aggressively repurchasing their own shares.
The buybacks.
Yeah, the buybacks. They have this massive billion-dollar authorization to buy back their own stock, and they've actually repurchased 5.9 million shares. They spent $162 million in Q4 alone, which brings their total utilized so far to $243 million of that billion-dollar authorization.
You don't buy back your own stock if you think the sky is falling.
No, you definitely don't. That sends a massive signal of confidence to the market. They have the deep pockets required to absorb a massive, unexpected shock and simultaneously fund their own hypergrowth.
They're playing the long game.
So what does this all mean for you? When you look at your own business landscape, your own career trajectory, or your own investment portfolio, the lesson from Coupang's Q4 is profound.
It really is.
True business resilience requires so much more than just digital savvy or a great app interface. It requires unshakable, hard-to-replicate physical infrastructure. It requires a deep, immediate understanding of how to regain consumer trust when it breaks. And perhaps most importantly, it requires a massive cash buffer to weather the unexpected storms that will inevitably arrive.
It is the ultimate corporate balancing act, managing the immediate, visceral fallout of an internal betrayal while keeping your eyes firmly fixed on laying the concrete for tomorrow's international expansion.
To quickly recap the journey we've been on today, we've watched a giant navigate a highly targeted insider breach affecting 33 million accounts.
Right.
We've seen them take a billion-dollar financial hit to immediately make things right with their customers, all while simultaneously pouring another $1 billion into the heavy physical infrastructure required to achieve triple-digit hypergrowth in Taiwan.
It's a story of unexpected vulnerability paired with incredible structural strength.
It really is.
This raises an important question. We've spent a lot of time today talking about how Coupang is building these massive, hyper-localized physical supply chains, literally laying down their own delivery networks country by country as a defense mechanism.
Yeah.
If a company with $6 billion in the bank feels the need to build these localized fortresses just to survive and compete against purely digital AI disruption, what does this mean for the future? Are we entering an era where the most valuable tech companies will actually be the ones that are the least digital?
Wow. That is a completely different way to look at it and a truly fascinating thought to leave on. If the ultimate defense against digital disruption is the messy reality of moving real boxes to real doors, the companies pouring the concrete today are going to own tomorrow. Thank you for joining us on this deep dive into the real-world clash of digital security, physical logistics, and global expansion. Keep asking those hard questions, keep looking for those aha moments in the data, and we will catch you on the next one.